$70, that is not a number silver has spent much time above in recent memory, and yet here we are Monday morning $70.56 on the screen. And before we go anywhere, here is what I told you last week. I said watch $68, I said that level was the floor. If silver holds $68, the structure stays intact. It did not just hold. It bounced hard off that level midweek, and it has not looked back since. That call is on record. You were watching it with me. Now we need to talk about what comes next, because the move that started at $68 support just collided with something much bigger happening on the other side of the world. And by the time we get to the middle of this video, the number I am going to show you out of Shanghai is going to completely reframe how you are thinking about this market right now. Stay with me. My name is John. I spent 15 years working inside currency and commodity markets before I started making these videos. I have sat in rooms where these decisions get made. I have watched what happens when retail investors get the wrong information at the wrong time. That is why I am here. Currency Insider exists for one reason: to give the people watching their savings from home the same level of analysis the institutions are getting. Everything I show you today comes from publicly available sources, and I will name every single one as we go. If this kind of calm, data-first breakdown is what you have been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed yet, now is the time, because what we are covering today is part of a bigger picture we are building week by week. Here is exactly what we are getting into. First, what the Shanghai data is actually telling us about physical supply right now. Second, how the paper market and the physical market have split apart in a way that is genuinely unusual. And third, how I am personally thinking about all of this using the 3 lanes framework, because when you see all 3 lanes at once, the picture gets a lot clearer. Let me give you the market context as of right now, because the price action this week is not random noise. Silver is sitting at $70.56 as we record this. 3 weeks ago, it was holding around the $68 level I flagged for you. If you are holding physical silver right now, you felt every single dollar of that move. Now, here is the part most channels are not talking about carefully enough. The US dollar index, the DXY, is at 100.07. Normally a dollar holding above 100 acts as a headwind for silver. Dollar-strong commodities under pressure, that is the usual relationship. But silver is not following that script right now. It is pushing higher against a relatively firm dollar that tells you something is overriding the currency dynamic. And what is overriding? What triggered this entire video is a number that came out of Asia this week that I genuinely had to look at twice when I first pulled it up. Quick question before we go deeper: drop in the comments right now. Are you holding physical silver, mining stocks, or both? The comment section here becomes a real-time sentiment tracker, and I read every single one. Here is the number. The Shanghai Gold Exchange is currently trading silver at a $7.24 premium over Western spot prices. That is a 10.23% divergence. Now let me put that in plain English, because I want to make sure this lands properly. Imagine you own a warehouse of silver in London or New York, and simultaneously someone in Shanghai is willing to pay 10% more for that exact same metal right now, not eventually. Right now, what do? You ship it east, and that is exactly what is happening. The physical metal is being pulled toward Asia because the price gap makes it commercially rational to move it there. The Silver Institute and the Shanghai Futures Exchange data both point to the same dynamic. Eastern physical demand is running hot, while Western paper markets are still trying to price silver as if this gap does not exist. Think of it like a river that has been dammed on one side. The water does not care about the dam. It finds the lowest point and it flows. Right now, the lowest point, meaning the highest profit, is Shanghai. And the silver is flowing accordingly. Now here is where it gets more complicated, and I want to be honest with you about both sides of this. The COMEX warehouse data is showing continued withdrawal pressure. Registered inventory has been declining. When I say registered inventory, I mean the silver that is actually available for delivery against futures contracts, not just the silver sitting in COMEX vaults on behalf of investors. The registered pile is the one that matters for delivery. And that pile has been shrinking. If you are a trader who sold a futures contract promising to deliver silver and you need to source that silver from COMEX warehouses, a shrinking registered inventory makes that harder and more expensive. That is the setup for what traders call a short squeeze. A short squeeze is not complicated. Think of it like a car park that is filling up fast. Everyone who parked there assumed they could leave whenever they wanted. But if the exits start narrowing, if available silver for delivery keeps declining, the people who need to exit their short positions start competing with each other for the remaining spots. That competition pushes price. It does not always happen, but the conditions for it are building. If you know someone who has been watching silver this week and trying to make sense of the moves, share this video with them right now. This breakdown took time to put together, and the people who need it most are probably not searching for it. Now let me show you the other side, because this is where I want to earn your trust and not just tell you what feels good. The 10% Shanghai premium is real, but premiums can reflect more than pure physical scarcity. local taxes, financing costs, market structure differences between Eastern and Western exchanges. Import duties. All of these can inflate a premium number without it meaning the world is running out of silver tomorrow. The Silver Institute is careful about this, and so should we be. What the premium tells us is that Eastern demand is structurally elevated right now. It does not tell us that a $100 price is inevitable or that COMEX collapses next Tuesday. I am flagging it because it is a genuine signal, not because I want to build a story around it. Stop. Before we go any further, I want to do something that most channels in this space never do. I want to show you the number that actually supports the cautious case, because intellectual honesty is the only thing that makes this channel worth watching. The US 10-year yield is at 4.41% right now. Elevated yields mean the opportunity cost of holding a non-yielding asset like silver is real. Every dollar sitting in silver is a dollar not earning 4.41% in treasuries. Institutional money does not ignore that math. Some of the buying we are seeing may reflect short-term rotation and tactical positioning, not a structural decade-long shift. I believe the structural case is building, but I want you to hold both thoughts at the same time. Now let me pull back to the bigger picture for a moment, because no silver analysis in 2025 is complete without addressing the macro forces moving underneath the surface. The DXY at 100.07 is not just a number, it represents a dollar under quiet but persistent pressure. The Congressional Budget Office has been publishing deficit projections for the US that are genuinely difficult to look at without feeling some concern. I am not saying the dollar collapses next Tuesday. What I am saying is the math is getting harder to ignore. When you run persistent trillion-dollar-plus deficits and the world is watching, the institutional response is not to panic, it is to quietly diversify, and that diversification has been showing up in World Gold Council data consistently. Central banks, not traders, not hedge funds, not retail investors. Central banks have been net buyers of gold for multiple years running now. These are not traders. They do not check price charts every morning. When a central bank reallocates reserves into precious metals, that is a multi-year decision made by committees of people who have access to information the rest of us piece together from public reports. That steady institutional accumulation creates a floor that is very different from speculative buying. For our UK viewers, the LBMA Vault data out of London has been showing similar dynamics. London remains one of the most important physical gold and silver clearing centers in the world, and the flow data from the London Bullion Market Association tells a consistent story. Physical demand from institutional and sovereign buyers has not softened in any meaningful way. De-dollarization is a decade-long structural process. It is not a Tuesday event, but the direction of travel is visible and documented. Let me say something briefly about industrial demand because it connects directly to the silver story and it gets oversimplified in most coverage. Silver is not like oil where you can watch it burning in a car engine. It is hidden inside electronics, solar panels, connectors, medical devices, and EV components. It is everywhere, and it is rarely recycled perfectly because it is dispersed in tiny amounts across massive industries. The Silver Institute tracks industrial offtake carefully, and the direction of that demand driven by AI hardware build-out, solar panel manufacturing at scale, and the electrification of the energy grid has not reversed. In the UK, the North Sea energy transition and the government's solar rollout ambitions represent real silver offtake at scale, not a theoretical future. I am not going to give you a precise ounce per megawatt figure because that would be false precision and you deserve better than that. What the data shows is the direction of demand, and that direction is up. Alright, let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate what is noise from what actually matters. Lane 1 is the paper market, the blue lane. CFTC Commitment of Traders data shows managed money positioning in silver has been adjusting through this move. Hedge fund. Net longs are not at historic extremes, meaning there is room for further positioning to build if the momentum continues. The futures market is under yield pressure, but it is not structurally broken. Lane 2 is the physical market, the silver lane. This is where the most interesting signal is right now. The 10.23% Shanghai premium from the sea, the COMEX registered inventory withdrawals, and the Royal Mint in the UK reporting continued retail demand for silver coins and bars. All 3 physical indicators are pointed in the same direction. Lane 3 is the macro lane, the gold lane. DXY at 100.07, 10-year yield at 4.41%, central bank buying continuing per World Gold Council data, and a fiscal backdrop that structurally favors hard assets over the medium term. In 15 years watching currency and commodity markets, the times I have seen all 3 lanes align in the same direction even briefly have historically been some of the most significant moments in these markets. I am not saying we are there today. I am saying it is worth knowing what to watch for. When the paper lane is showing room to build while the physical lane is showing real Eastern demand and the macro lane is pointing toward structural dollar pressure, the historical pattern has been that paper eventually catches up to physical reality. That is a framework, not a forecast. You decide what to do with it. Here is the One thing I am personally watching this week. One thing, the next CFTC Commitment of Traders report drops Friday. I am watching managed money net long positioning in silver specifically. If that number moves meaningfully higher, if the hedge funds who have been sitting on the sidelines start adding length after this $70 break, that is confirmation that institutional money is treating this level as a genuine breakout and not just a spike. If net longs stay flat or decline despite the price move, that tells me the move is being driven by physical and macro factors without paper market conviction behind it yet, which actually changes the risk profile. That is the number. That is the day. That is exactly what I am looking for. This is my one call for the week, John FX. Insider, on record. I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you because this is where most channels pick a side and run with it. I am not doing that today. Here is what needs to happen for the optimistic picture to develop. COMEX registered inventory continues to decline, the Shanghai premium holds above 8%, CFTC net longs build on Friday's report, and the DXY fails to reclaim 101. If those four things develop together over the next 2 to 3 weeks, the case for a sustained move higher in silver gets structurally stronger. Here is what needs to happen for the cautious picture instead. Yields push back above 4.6%. The dollar reclaims strength above 101. The Shanghai premium compresses as Chinese demand normalizes and COMEX inventory stabilizes. If that develops, the $70 break may look more like a spike than a launch. Both are genuinely possible right now. Your job is not to pick one and emotionally commit to it. Your job is to watch which conditions are actually developing in real time. The market will tell you. You just have to be watching the right things. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the two questions, if you got value from this today, the like button takes 1 second and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you two things and I genuinely want your answers, not just a thumbs up. First, are you currently holding physical silver, silver ETFs, or mining stocks, and has today's $70 break changed how you are thinking about your position? Second, when you look at that 10% Shanghai premium, does it read to you as a genuine physical scarcity signal, or do you think it reflects local market structure more than global supply pressure? Drop both answers below. The comment section here becomes a real-time sentiment tracker and I read every single one. Subscribe because next week we are going deeper into COMEX registered inventory mechanics. I am going to show you exactly how to read the CME warehouse report yourself and what the numbers actually mean for price discovery. That is a skill worth having. And if someone in your life is watching their stack right now and feeling confused about what is happening, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market, protect your currency.